during the Romans era, right, money was gold or silver. In fact, it was silver, so it had an intrinsic value. So it was, but since we have paper money or even, book value money, where we just have transactions on our accounts, money doesn't have any intrinsic value. Now, nevertheless, what's the difference between Bitcoin and the money that we use? Well, Bitcoin is completely unregulated, whereas money is something where you have a central bank that is in charge of keeping money's value, right? And I think it is said that people voted Donald Trump because they were, because of the inflation that took place in 2021 and 2022 in the United States. With hindsight, I must say, it's just impressive how central banks managed to get this ghost back into its box and bring inflation down to whatever, 2 or 3%, very quickly, right? And that's what central banks can do. Now with Bitcoin, what is the central bank behind Bitcoin? No one, right? I mean, can you touch the Bitcoin? No. Can you plaster your wall with the Bitcoin? No. What can you? I don't want to talk this down too much, but it's just something I find pretty eerie it's just people who want to make a lot of money and who incur enormous risks. And as long as that's separate from the formal financial system, so be it. People earn a lot of money, people lose a lot of money. But now with Bitcoin moving to the core of the financial system, and banks actually putting this on their books, we will see the moment when the government has to step in and save banks because they misspeculated on Bitcoin. And it's not very nice. Okay, so much about bubbles. Now, here coming to the point, we shoot down the bubble term. We set it equal to 0 because we just assume that there are no speculative bubbles on foreign exchange markets that last forever. So we do have speculative bubbles on housing markets. We also have speculative bubbles on foreign exchange markets, but they do not expand forever. So there was a time when an apartment in Tokyo cost as much as, basically the GDP the GDP of some medium-sized African country. But these times are gone. The housing market collapsed in Tokyo, and no, this was not an ever-expanding bubble. And that's all we need. All we need is we basically exclude infinite explosion. So we eliminate the bubble term, and then we're back at this. Assuming that the nominal exchange rate does not explode or implode, we can set the last term on the right-hand side of 6.5a equal to 0, which yields this. And this is basically the nominal exchange rate. The nominal exchange rate, and this is a very important message, the current nominal exchange rate depends on current and expected future values of the domestic money supply, which has a positive sign, the level of domestic real income, which has a negative sign, the foreign price level, which has a negative sign, and the foreign nominal interest rate, which has a positive level. It's not just what happens now, it's also what people expect to happen in the future. And that's the key message to be taken away from this thing here. Why is this so important? Well, how do you imagine do those press conferences take place in which Madame Lagarde or Mr. Powell or whoever's in charge goes in front of the press and then makes a statement about monetary policy? Pardon?
We got the presentation reverse the highlights and we thank for that.
Mm-hmm.
So Madame Lagarde and Chairman
Powell, yeah.
Powell also mentioned that we need to manage the public expectation
Mm-hmm.
to get the effective policy.
Right,
Yeah.
exactly. Now, So the central bankers know about that. But the bottom line is every word in their press conference statements is written down and discussed in advance. So it's not like me. I mean, I come to the classroom, I know more or less what I want to talk about, but then I talk a little bit about Johann Wolfgang von Goethe, then talk a little bit about the current US government, then I talk a little bit about, whatever. Then I improvise. Central bankers are not allowed to improvise when they show up in public. Why? Because every word they say influences expectations. So if Madame Lagarde has a slip of tongue and says, we are kind of relaxed about inflation in the future, then thousands of people in financial markets will interpret that as about monetary policy becoming more relaxed, and that will be immediately seen in the nominal exchange rate. So the nominal exchange rate depends on what's happening now and what people expect to happen. So there's a lot of people at their Bloomberg terminals and Reuters terminals every day trying to extract information from what people say and what they observe. And it's not just about tomorrow, it's also about the day after tomorrow, it's also about the day of tomorrow. Everything that shapes your expectation about the future immediately is reflected by the nominal exchange rate. This is the essence of the model and also of rational expectations. So this is basically the most important thing that you have to know about nominal exchange rates. It's an expectations-driven variable. And this is something that the non-economic audience finds so weird, right? So there's something happening on markets that is not directly linked to anything happening on another part of the market. It's just linked to a change in expectations. So, for example, starting in mid-2014, the US dollar appreciated substantially against most currencies in the world. Did anything happen in monetary policy in the United States or in other countries? The answer is no. The only thing that generated this appreciation was that people expected an end to quantitative easing. In mid-2014, a consensus emerged that the Fed will probably at some time be more restrictive on the monetary policy. Now, this hadn't happened yet, right? But nevertheless, markets put this into this equation and said further down the road, this is going to go down. And if we expect this to go down in the future, then this going down in the future makes this go down in the present. So there's two things that economists understand better than engineers, and practically better than everyone. And that's something I really encourage you to be confident about. What is it? The role of expectations, which is a macro thing, and incentives, right? That's micro. I mean, in microeconomics, you learn when you do contract theory, moral hazard models, adverse selection models, it's all about incentives. That's something that we understand better than engineers. And we understand the role of expectations. That's also something that drives engineers nuts. And I'm saying that because I used to be a professor at a technical university, so I was teaching engineers. And these guys are confident, right? Their math is pretty sophisticated. But I said, look, folks, there's something that you can learn from me, and it's the role of expectations. That's something that you don't have in your engineering models, because expectations are not, this is not about human beings, but economics is about human beings, and so expectations matter. So this is almost like a sermon I'm giving here. So let me continue. So here's just an interpretation. Why does the future matter for the current exchange rate? Now, the bottom line is, so you have the nominal exchange rate, which depends on the difference in price level. The price level depends on basically the money supply and output and the interest rate. And the interest rate depends on the future the expectation about the future nominal exchange rate. So that's the channel. Good. So expectation about the higher nominal exchange rate in the future result in higher nominal exchange rate in the current period. So what have we learned? And let me conclude here, because I think this is a good point to basically close. The key message is the current nominal exchange rate depends on current and expected future values of exogenous variables. That's the key point. Money supply, output, interest rates, etc. And coming back to Juan's point, central bankers are very much aware of this. Central banking is doing things, but also saying things. And saying things means expectations management. So you communicate. So this means the importance of exchange rates for expectations in determining exchange rates. So, and this is because the exchange rate is the price of an asset. Domestic currency is like an asset whose price fluctuates, and like other asset prices, exchange rate are determined by expectations about the future. So it's not that here we have something that's completely confusing. When we talk about financial markets, not talking about expectations is naive. Good. Now, what are the shortcomings? Well, the monetary model is based on a lot of heroic assumptions: perfect capability and risk neutrality, permanent PPP, money neutrality. And the monetary model also has one drawback, which is called excess volatility. Now, the monetary model, and let me tell you this without going into the math, the monetary model suggests that the nominal exchange rate is less volatile than monetary fundamentals. Now, the sad thing is we find that it's the opposite. Nominal exchange rates are super volatile compared to what we call the monetary fundamentals. But there is a solution to that. So, my suggestion is this is the last slide that's relevant for the exam. Okay? So the exam is far away. I've been told that the exam will be somewhere in August. Wow, that's far away, which is okay, right? I mean, don't forget everything, but you will have a lot of time to, go over my notes. Now let me just tell you in 5 minutes what I plan to do, but it's not a big, we did balance of payments accounting an entire day. I planned not to do it, but then I did it, which is good because you had the Haliassos class and then you started with my class, and I think it was a good idea to, not to say you should have looked at that beforehand, but to actually do it. I guess that in future vintages of this course, I will do it the same way because balance of payments accounting is also, a good start. So we spent one day on balance of payments accounting. Then we had this little thing on panel data models, which I think is also important. You have to understand what fixed effects are good for and what they do to the data. And so we're missing kind of an hour and a half. But I want to get across what I would have done in that hour and a half, and that's talking about this stuff. Now, this is a slide that I showed you on the very first day. This is the evolution of the Swiss National Bank's foreign exchange reserves and of the euro-Swiss franc nominal exchange rate. So how many Swiss francs did you have to pay for 1 euro at different points of time? And you see that in 2007, you had to pay roughly 1.6 Swiss francs for 1 euro. And by now, you have to pay less than 1 Swiss franc for 1 euro. So there's a massive depreciation of the euro vis-a-vis the Swiss franc, or a massive appreciation of the Swiss franc vis-a-vis the euro. At the same time, the Swiss National Bank has accumulated massive foreign exchange reserves. Why did it do that? Well, it did do that because Swiss National Bank responsive policymakers were afraid that the appreciation would be even stronger. So Swiss industry, including the tourism industry, said, look, if the Swiss franc is going to be too strong, then nobody will come and take a holiday in Switzerland. Nobody will buy Swiss goods anymore. And so what the Swiss National Bank is, remember, why should the nominal exchange rate affect net exports? Well, we talked about this yesterday, right? Just terms of trade and sticky prices. Now, the Swiss National Bank, thus, given the massive demand for Swiss francs in times of crisis, the Swiss franc being a safe haven currency, try to prevent a bigger appreciation by just intervening. Now, we don't have the counterfactual. We don't know what would have happened if the Swiss bank had not intervened. But the general reading was that this would have gone down even by more if the Swiss franc had not leaned against markets and bought euros in huge quantities. Now, this is one of the reasons, by the way, why Switzerland has such a miserable return on its net international investment position. Because they're sitting on all these government bonds from the Euro governments with interest rates of 0, right? Sometimes even negative. So remember, we had 10 years of super low interest rates. German government bonds had interest rates of 0%, and people were buying them nevertheless, and the Swiss National Bank bought them as well. And so they're earning essentially nothing on these government bonds. So this is why the primary income in Switzerland is so negative, because they have a lot of assets, but these assets have very low returns. And it goes back to this activity here. Now, the question is, does that make sense? And this brings us to a class of models that is called portfolio balance models. And I'm taking 4 minutes, and then I'll conclude. Portfolio balance models are models that acknowledge that uncovered interest parity is not the only thing that you have to know about foreign exchange markets. Now, here's uncovered interest parity is everything that you had to know, basically. And people become more and more aware that for various reasons, people are willing to hold currencies even if the expected return on these currencies is lower than in another currency. So people are willing to hold dollars even if some other currency generates a higher expected yield. People are willing to hold Swiss franc even if the expected return is not comparable to some other currency. And there's various reasons for that. Now, if that's the case, then all of a sudden, this thing comes back into play, right? This is how we started the whole presentation. I said there's demand for currency coming from the current account side. There's demand for currency coming from the financial account side. Then this morning, starting this morning, I just wiped it out and said, forget about it. International financial markets are so big that it's just about UIP. And now in this last section, I'm bringing it back to the front. And this is important because all of a sudden, when you have these portfolio balance models, quantities matter. With UIP, quantities don't matter. Whether more people move to Turkey to spend a holiday, it doesn't matter. It's just about interest rates and expectations about the future exchange rate. Now, portfolio balance models give a role to quantities, and that's the direction that exchange rate economics has been taking in the past 10 years. Good. And it turns out that if you're in that class of models, then of course foreign exchange interventions matter. But as I said, I'm playing it fair, right? It's not that I say, okay, you have to read that, and then I'm gonna this is where, in German there's the word klausurrelevant, so relevant for the exam. And this is the most important question that students ask when the exam moves closer. They say, is this klausurrelevant? And then I say, And then they want to have detailed instructions and say, okay, is that equation relevant for the exam? Is that equation relevant for the exam? I say, come on. I mean, this is a university. I mean, now, but in terms of pages, I stop here, right? So, and everything that, the rest is just bonus material that I will not inquire you about. Alrighty, let me just note that down so I don't forget it when but I won't. And I say that we take a break, and then we talk about the one problem set that's left and the mock exam, because that's important. Good. I mean, we did a lot of things. I mean, that's a lot of stuff that we did. So cutting off something like 10% or 7% is not, or 5% is not a big omission. So, do you think it's necessary to give it a little bit of energy? So just